After having had the time to look at the payback period, it is now important that we look at something else. And so I want to take you to the next. That is an assignment for you. You have been asked to look at this company here called Magisafi. We are evaluating a customer relationship management or CRM system with the initial cost of let us use 100,000 Kenya shillings so that it can be able to merge through. Otherwise, we do a lot of conversions. Then the projected cash inflow is as shown below. So determine the payback period for this particular software. That is your assignment for this session. So now let's talk about, of course, there's another consideration for you where a company needs to choose between two proposals. Every day you are actually poised with scenarios that require you to make a decision. You need to decide and say why are you not eating food A and you are going for food B? Why are you not doing this job, you are doing the other? That means you have options. So in this e-commerce system, they have two systems. All of them have, both of them have a cost of 2,000 US dollars. I would still ask you to use Kenya shillings. All of them have that as their attached initial capital, whereas the system A has an annual cash inflow of Kenya shillings 75,000, whereas that is system B has an annual inflow of Kenya shillings 50,000. With illustration, of course, determine which system would they pick, and you need to justify your choice. Why that? There is what I call return on investment, the rate at which the investment is coming back. That is in simple terms, the measure of the efficiency of an investment. And you're comparing that with the benefits actually in relation to the costs. In other words, we are now turning what we are calling the CBA, cost benefit analysis, into a ratio or into a percentage rate. So it is a simple way to gauge profitability of the business. And this is a formula. ROI, return on investment, given by. Now you take your net benefits, and this one is the same as if we were to do mathematics. This net benefits is the same as the CBA, cost benefit analysis, all over your total costs. This is total cost. Multiply that by 100, then you get the percentage. That determines the profitability of the business. So, going back to our example that we did earlier, if you are not aware of how this was done, just switch to the first tutorial, and we'll have a look at how we were able to solve this. So you're given a company, and this company is looking for to have a system that has a lifespan of 5 years, and the system has a number of tangible costs like initial software license at Kenya shillings 50,000, implementation and the training Kenya shillings 20,000, hardware upgrade 10,000, and annual maintenance. So for the annual maintenance, again, you need to multiply that by 5 because you have got 5 years. Every year 5,000, so that is 25,000. So you add your 50,000 plus your 20,000 plus your 10,000, that is 80,000, plus your 25 because you multiply this by 5, and that gives you your 105,000. Now the system has the following annual benefits: reducing inventory, carrying costs, Kenya shillings 15,000, improved operation efficiency or labor saving at 10,000, decreased stock out 80,000. So these benefits are said to be annual benefits. So you have to sum them and then you multiply by 5. Otherwise, you have 50,000 plus 75,000 plus another 40,000, as you'll see in the next slide. So this is what you have. The total cost is this amount, and the total benefits is as shown here, which gives you a net benefit of 60,000. So ROI, return on investment, will be net benefits divided by total costs multiplied by 100. In this case, you have 60,000 all over 105,000 multiplied by 100, and that gives you 77.1%. And that is how you find ROI, as simple as that. On the next segment here, we are talking about the net present value. What is this thing that we are referring as net present value? This method sometimes giving you a scenario where you have you want to determine the value of your asset, and you want to look at a given period, maybe in the next 20 years, in the next 5 years. So it's a method that is that discounts the future cash flows back to their present value, providing a more accurate measure of the project profitability. So again, this is a measure that is used to determine the profitability of a given business. How do you find it then? This is a formula of finding the net present value, NPV. The formula is given by we have summation of CT all over T plus R into the bracket raised by T minus CO, and in this case we are moving from T equals to 1 up to this particular N. So let me explain that formula in detail. The CT means the net cash flow for the period T. The net cash flow for the period T. CO means the initial investment that you had, whereas the R is the discounting rate, often cost of capital, and then your N would be number of periods. So you will be able to replace these values once you have been able to determine what is the value of N, what is the value of R, and what is the value of CT. So we would want to consider an example here using the very example that we had earlier on in our tutorial 1. Again, if you have not watched that tutorial, I highly recommend that you go and look at it. It will simplify your work. In the same issue that we have been dealing with, it is very simple. We already know what is the initial investment that these people are using, and that is 105,000, whereas the annual, whatever they are going to get annually, okay, whatever they are going to get annually, again, you remember we had done it, it was 165,000. Then there we have given additional information here that they decreased at stock, with a discount rate of 10%. So we need to calculate its net present value. We are given the discounting rate R at a 10%. So with this, you can be able to come around here and do your calculations. So your initial investment, CO, is the same as the licensing, implementation, hardware, all that. Then you have the annual, from here, the annual cash flow, you remember. So you're going to do them annually. You will separate them in an annual basis. You are not going to do it lump sum. So like in the first year, what we are going to do in the CT for the first year, arts benefits minus the annual maintenance, Maintenance is what is withdrawing money from us. So add the benefits and then minus the maintenance. And you have realized that in the first, let me just show you how that was arrived at. Look at annual maintenance fee is this much. That is annual maintenance fee. But what is the benefits? The system has the following annual benefits. What are they? Because those others will be done, dispensed with once and for all. Reducing the inventory costs by 15,000. Improved operational efficiency, labor saving at 10,000. And then decreased stockouts, Kenya shillings 8,000. So when you take your 10,000 plus your 15,000, then you have how much? That gives you 20,000. Is it? No, 25,000. Then you add your 8,000, then that gives you 33,000. But remember, there is an annual maintenance fee that you must now deduct from this benefit that you're getting annually. So that is why you have this value here, 28,000. This 28,000. So during the first year, the amount that was gotten is the same as 28,000, which is your CT. Is that really the truth? Yes, your CT divided by 1 plus the rate, which was 10%. 10% when you convert it into a decimal point 0.1. Then you raise this by 1. That is in year 1. Then you get the amount as you can see here, 25,454. Then you would come here in year 2. Now your R becomes, it is the same. Your T changes is 2. You have this value. In the next year, you have the same CT because it's not changing, it's constant. And your T now is 3. You move on, you have T is 4 and T is 5. So the total present value, you add all these values from here this way. Sorry, you add these values, all of them. You add those values. And when you add these values together, you get 106,142.05. So the net present value, that is the total present value inflows. But the net present value at the year 5 will be, you take your 106,000 now, 142.5 minus the 80,000, which was the initial hardware. Let me just confirm for you what this was. This 80,000. Yes, that was the initial investment. It was standing at 80,000. So the net present value is giving you this 26,142. So this measure is a bit accurate compared to other measures or other calculations that you might have done, like the cost benefit analysis. This is more accurate. And that is how you do the present value calculation. Good. It was nice having you. I wish you the very best as you expand your knowledge on this area. Do more research, and I believe you will make it. If this content is nice for you, please like it, share it as we move forward.